Hi everyone, Ramiz Gabriel from IT Wealth Management here. This is the fourth video in our insurance series, Reality of Risk. We're going to discuss the probability of an event occurring, impact on retirement plan, risk management need by life stage, mortgage insurance versus life insurance, and ethical standards. So with that, let's begin. This is a risk calculator from Canada Life called Know Your Risk. You can find it if you Google it. It shows the probability of death, disability, or critical illness before age 65. The risk of dying before age 65 is relatively low for many people. But factor in the risk of a disability or a critical illness, and the picture changes. Thankfully, recovery is often the outcome, but such events can be devastating to your financial future. Consider this example of a couple, a 39-year-old female and a 40-year-old male. The risk of becoming disabled before age 65 is 60%, becoming critically ill before age 65 is 35%, and dying before age 65 is 10%. The combined probability of one of these events occurring before age 65 is 75%, which is staggeringly high. There's also a significant risk to retirement. Disability that causes cessation of work for a period of time, critical illness that requires dipping into funds earmarked for retirement, or lost income due to death. Any one of these events can derail a retirement plan. Consider this graph. The dream retirement plan is to steadily accumulate wealth through working years until the desired retirement age is reached at the desired net worth. However, the reality is that a third of individuals will use their savings, one of the main drivers to increasing net worth, to deal with an event that can be funded through insurance. This means that these individuals will either have to delay retirement to reach the net worth desired, or retire at the original time but with a lower net worth, and therefore not have the retirement they had envisioned. Now I want to talk about the various risk management needs because they differ depending on life stage. The first three are needed throughout your lifetime. Your first line of defense is an emergency account. These are savings earmarked for emergencies. After that is a line of credit. Most people who go into credit card debt are forced into it due to emergencies, and credit card interest rates are exorbitant. You can qualify for a line of credit when you are earning an income. If a job is lost, though, which is potentially when you need a line of credit, you wouldn't qualify for one. So it's highly recommended to get one while it is not needed. The next is medical and dental coverage. The next five are insurance policies. The first one is critical illness insurance. The need for critical illness insurance increases steadily throughout your career, peaking around retirement age, and decreases as you age past retirement. The need for disability insurance is very important while you are earning an income, as it protects lost income from cessation of work due to a disability. The need decreases as you approach retirement since the amount of income lost decreases, and it is no longer needed upon retirement when employment income ceases completely. By contrast, the need for long-term care insurance is low earlier on in life and increases as you age. Term life insurance protects lost income to the family upon death of the insured. After retirement, there is no income that otherwise would be lost, and therefore the need diminishes. If you want to leave additional inheritance to your children, or cover the tax liability cost of a family property, term insurance can be converted to a permanent policy. This will be discussed further in the next video about estate preservation and wealth transfer. I also want to say a quick word about mortgage insurance. I highly recommend life insurance over mortgage insurance for two reasons. First, mortgage insurance will go directly to your mortgage provider rather than to you. This gives you less control. Second, and more importantly, mortgage insurance declines with the mortgage, whereas life insurance coverage does not change throughout the term of the policy. This allows you to both cover the mortgage liability and recoup lost income due to death. Finally, in this last slide, I want to discuss client protection and ethical standards. At IG, we conduct analysis to demonstrate the amount of insurance needed and recommend that to the client. By industry standards, if we cannot demonstrate that the amount of insurance recommended and sold was appropriate, we could lose our license, and we are heavily audited. In the event that the client specifically requests an amount higher than what we recommended, we carefully document that before the insurance is sold. So that's all for me. Thanks for watching, and be sure to check out the last video in the insurance series, Estate Preservation.